Growth stocks do not need lower yields. They need real yields to fall for the right reason. Because the same decline in the 10-year Treasury yield can send two completely different messages. Yields can fall because inflation pressure is easing, the economy is holding together, and investors no longer demand such a high real return. That is the good version. Or yields can fall because investors see a recession coming, credit conditions are tightening, or something in the financial system is beginning to break. That is the bad version. The headline looks the same in both cases. Treasury yields are falling. But only one of those environments gives growth stocks what they actually need: lower valuation pressure without collapsing earnings expectations. And based on the latest data, that trigger has not been confirmed yet. Whenever the 10-year Treasury yield drops, the market tends to repeat the same line. Lower yields are good for technology and growth stocks. That is not completely wrong. Growth stocks often depend heavily on profits expected 5, 7, or even 10 years into the future. When the rate used to discount those future profits falls, those profits become more valuable today. That can support higher valuations. But it is only half the equation. A stock's value depends on two things: how much money the company is expected to earn, and how much investors are willing to pay today for those future earnings. A lower discount rate helps the second part. But if the economy is weakening and earnings estimates are falling, the first part may be deteriorating at the same time. So the useful question is not, did yields fall? It is, why did yields fall and what happened to earnings while they were falling? To answer that, we need to separate the 10-year Treasury yield into three numbers: the nominal 10-year Treasury yield, the 10-year break-even inflation rate, and the 10-year real yield. In the latest fully aligned official data, dated July 17th, the nominal 10-year Treasury yield was 4.55%. The 10-year real yield was 2.31%. The difference between them, the 10-year break-even inflation rate, was 2.24%. In simple terms, nominal yield equals real yield plus expected inflation. The nominal yield is the number that normally appears in headlines. The break-even rate is a market-based estimate of average inflation over the next 10 years. And the real yield tells us the inflation-adjusted return investors are demanding from long-term government debt. Fred calculates the break-even rate from the difference between nominal Treasury yields and inflation-indexed Treasury yields. For growth stock valuations, the real yield is the key number. When investors can earn a higher real return from Treasury securities, expensive growth stocks must offer more potential upside to remain attractive. When the real yield falls, that valuation hurdle becomes easier. But the reason it falls still matters. Let's start with the environment growth investors actually want. Inflation gradually cools. The labor market slows but does not collapse. Consumer demand becomes more balanced. Credit conditions remain stable. And analysts do not begin cutting corporate earnings forecasts. In that environment, the bond market may begin demanding a lower real return. The 10-year real yield starts moving down. Break-even inflation remains reasonably anchored rather than suddenly collapsing, and the nominal 10-year yield falls without the economy sending a major distress signal. That is the good decline. Growth stocks receive support from both directions. The lower real yield reduces the discount applied to future earnings, and those future earnings are still expected to arrive. Here's a simple example. Suppose a company is expected to generate $100 in cash 10 years from now. At a 9% discount rate, that future cash flow is worth roughly $42 today. At an 8% discount rate, it is worth about $46. Nothing changed about the expected cash flow. The company did not suddenly sell more products. The market simply became willing to pay more today for the same future earnings. Now combine that valuation support with stable or rising earnings estimates. That is the environment growth stocks want. The price investors are willing to pay for future earnings rises without those future earnings being damaged. Now imagine the same 10-year Treasury yield falls for a very different reason. Consumers begin cutting spending. Companies freeze hiring. Banks tighten lending, credit spreads widen, and investors become more concerned about recession. Money moves into Treasury securities for safety. Bond prices rise and yields fall. At first glance, that looks positive for growth stocks. The discount rate is moving lower. But underneath that move, analysts may also be cutting revenue and earnings forecasts. A company that was expected to earn $10 per share next year may now be expected to earn only $7. The market might be willing to pay a slightly higher multiple because rates are lower, but that higher multiple is being applied to a much smaller earnings number. Lower rates cannot automatically repair a collapsing earnings outlook. That is the bad decline. The valuation environment improves, the business environment deteriorates, and there is no guarantee the first force will be strong enough to offset the second. This is why saying falling yields are bullish is incomplete. Sometimes yields fall because inflation pressure is easing. Sometimes yields fall because the bond market is afraid. Those are not the same signal. The same headline can hide two different markets. Let's use the current numbers. The nominal 10-year yield is 4.55%. The real yield is 2.31%. Break-even inflation is 2.24%. Now suppose the nominal yield falls by 30 basis points, from 4.55% to 4.25%. The headline would say, Treasury yields fell sharply. But there are two very different ways we could arrive at 4.25%. In the first path, the real yield falls from 2.31% to 2.01%, while break-even inflation remains around 2.24%. That is potentially constructive. The real cost of long-term capital has declined, while long-term inflation expectations remain anchored. Now consider the second path. The real yield remains at 2.31%, but break-even inflation falls from 2.24% to 1.94%. The nominal yield still reaches 4.25%, but the message underneath the move may be very different. It could reflect healthy disinflation, but it could also mean the market expects weaker spending, weaker pricing power, and slower economic activity. The headline move is identical. The signal is not. That is why watching only the nominal 10-year yield is not enough. So what is the actual growth stock trigger? It is not simply a lower federal funds rate, and it is not simply a lower nominal 10-year Treasury yield. The one rate signal growth stocks need is a sustained decline in the 10-year real yield. Then we need three things to confirm that the decline is healthy. First, inflation expectations should remain reasonably anchored. We do not want break-even inflation collapsing because the market suddenly expects demand to disappear. Second, earnings revisions should remain stable or improve. Lower real yields are far more valuable when analysts are not cutting the future profits those yields are supposed to support. Third, growth stocks should begin improving relative to value stocks across a broader part of the market. Not for one afternoon, not just because a few heavily shorted companies suddenly bounce. The improvement should persist. So the hierarchy is simple. Core rate signal, real yields move meaningfully lower. Confirmation, inflation expectations remain anchored, earnings hold up, and growth regains relative strength. The trigger has not arrived yet. Now let's bring this back to the current market. The 10-year real yield was 2.36% on July 13th. By July 17th, it had eased to 2.31%. That is movement in the right direction for growth valuations. But 5 basis points over several trading sessions is not a new trend. The real yield remains close to a historically restrictive level and well above its average earlier this year. The 10-year break-even inflation rate was 2.24% on July 17th and ticked up slightly to 2.25% on July 20th. That tells us long-term inflation expectations remain relatively contained, but it does not tell us that real discount rate pressure has disappeared. So the current conclusion is clear. The growth stock trigger has not arrived. The bond market has moved a few basis points in the right direction, but that is not enough to confirm a meaningful easing in the real cost of capital. Growth stocks need a trend, not a brief fluctuation caused by one data release, one Treasury auction, or short-term positioning. This also explains why investors should be careful with this sentence. The Fed will cut rates, so growth stocks will rally. The Federal Reserve controls the short-term policy rate, but high-valuation growth stocks are heavily influenced by longer-term real yields. Those rates do not always move together. The Fed could cut while the 10-year yield remains high. That could happen if inflation expectations increase, government borrowing pressure remains heavy, or investors demand more compensation for holding long-term bonds. The Fed could also cut because the economy or financial system is already deteriorating. That may lower discount rates, but it may arrive alongside weaker corporate earnings. At its June meeting, the Federal Reserve kept its target range at 3.50% to 3.75%. It said economic activity was still expanding at a solid pace, while inflation remained elevated relative to its 2% goal. The June meeting minutes also noted that long-term inflation expectations remained anchored near 2%, while technology-led equity gains had received substantial support from higher earnings expectations. That is exactly why the current setup is not simple. Inflation has not clearly disappeared, growth has not clearly collapsed, and strong earnings are still helping technology stocks absorb high real yields. Growth investors should not wait for the word cut. They should watch the real yield and then ask why it is moving. What would confirm the good decline? A constructive signal would look like this. The 10-year real yield begins a sustained move lower. Break-even inflation remains controlled rather than falling abruptly. Corporate earnings estimates remain stable or continue rising. And growth stocks begin outperforming value across more than a handful of large companies. If those conditions appear together, the market would be telling us that valuation pressure is easing while the fundamental outlook remains intact. That would be a real growth stock trigger. What would confirm the bad decline? The warning signal would look different. Nominal yields fall quickly, but credit spreads widen. Economic data weaken sharply. Earnings forecasts are revised lower. And the growth stock rally is narrow, violent, and short-lived. That would suggest yields are falling because investors are seeking safety, not because the valuation environment has become healthier. Growth stocks might still rally at first. Markets often react quickly to lower rates. But without earnings support, that rally becomes much harder to sustain. Real yields do not control every growth stock. Companies still need strong demand, credible earnings, and reasonable valuations. A weak company does not become a strong investment just because real yields fall by 30 basis points. And a strong company does not automatically collapse because real yields remain high. Exceptional earnings growth can offset a difficult rate environment. That is why this signal should be used to understand the market environment, not to replace company analysis. The real yield tells us whether the wind is becoming more supportive. It does not tell us whether every company has a strong enough engine. Growth stocks do not need yields to fall at any cost. They need the real cost of long-term capital to decline without the earnings outlook collapsing beside it. That is the difference between a good decline and a bad decline. The good decline looks like this. Real yields move lower, inflation expectations remain anchored, economic activity holds together, and earnings expectations remain stable. The bad decline looks like this. Investors become afraid of recession or financial stress, money moves into Treasury securities, yields fall, but earnings expectations fall with them. Both environments produce lower bond yields. Only one creates a durable foundation for growth stocks. So remember the central idea. For growth stocks, why yields fall matters more than the headline that yields fell. Right now, the trigger has not been confirmed. Real yields remain high, and the recent decline is too small and too brief to establish a new trend. But now we know exactly what to watch. A sustained decline in real yields, anchored inflation expectations, stable earnings revisions, and improving relative strength across growth stocks. Even if those conditions begin turning positive, one major question will remain. Is the market rally actually spreading to more stocks, or are a handful of large companies still doing most of the work? That is the signal we will examine in the next episode. Do you think the next meaningful decline in yields will come from cooling inflation or weakening growth? Let me know in the comments. Last but not least, if you enjoyed this breakdown, do hit that like button and subscribe. Data reveals the truth and logic guides the way. I'll see you in the next one.